Hello, Jim Adams here from the YouTube channel Easy Investing Income. Today I want to share with you how I've really been able to increase my returns in my retirement accounts using the wheel strategy. I think you're going to really enjoy what I have. I'm actually going to share my trades that I made earlier this week and where I stand return wise. So stay tuned. Welcome to the Easy Investing Income YouTube channel. This channel is where I'd like to share with people how I'm actually using options to both retire early and to really increase my returns. And before I get started, I always like to share that there are risks involved with selling options. And if you want to try any of these trades yourself, please do your own due diligence and understand what you're getting into. So that being said, let's go ahead and get started. Now, I've been trading for over a year and I've done over 200 trades, and I've kind of learned some lessons. I do have a previous video you can actually watch that talks about a lot of the lessons I learned. So I've decided now to actually go into one of my retirement accounts and use the wheel strategy and see how I can do actually trading in that account, see if I can really increase my returns. So before I was able to do that, I did have to change the option level that I had in that Schwab account. Again, I'm primarily using Schwab, and it's a IRA account. I believe it's a Roth conversion IRA account. So I was able to apply for level 2, and within I think a day or two, Schwab gave me access, and it's relatively easy. I also have a video on how to get access within Schwab. You just answer some questions and you mention what kind of money you make on a yearly basis and what kind of, how long you've been trading, how many trades you make in a year, and they typically will give it to you. If you're really new to trading, you're new to options, they'll have you start off with doing something like covered calls versus allowing you to do what level 2 is. There's a level 0, level 1, and level 2. Level 2 with margin is actually what I asked for, because I do the wheel strategy, but I also do it with what I call put vertical credit spreads. So with having the margin associated with it, and you can only get that at level 2 for retirement accounts, I'm able to use less margin in those trades. I'm actually going to switch over to my trading spreadsheet so you guys can actually see the trades I made, and I'll explain that a little bit more. One of the things I did want to mention is I'm real excited about doing these trades in my retirement account. I'm again going to only be using safe option strategies. I don't want to blow up my account. In the 200 or so trades that I've done over the last year, I've only had really one blow up on me, and it didn't really blow up too bad. In the end, I think I took a $2,000 loss, but I was averaging $2,000 a month. And that was with Microsoft, and that was doing what I call a call vertical credit spread, and I'm no longer doing that. I'm primarily doing, in this wheel strategy, cash secured puts, covered calls, and what I call put vertical credit spreads, which is very similar to the cash secured put, but the only difference is it allows you, or with it, you actually buy an option farther out. So I'll give some of these examples when I actually get into the spreadsheet. I don't really want to repeat myself, but I wanted to just mention those 4 things real quick. So let's go ahead. Let me switch over to my spreadsheet. Okay, let me change the size of this. Let me put it up here on the left. Mainly to get it out of the way. So this at the very top was the security trades, and this is in one account. This was a $50,000 account. Again, it's IRA, and these are the actual holdings that it had. It had the Wisdom Tree hedged equity account or ETF. It also had DVY, IGH, and then this is cash, and this is the number of shares that I had in each, and then the values. And you can see I didn't have much cash. One of the requirements that you really need if you're going to do cash secured puts and these put credit spreads. You need to have enough cash. So the first thing I did is I went ahead and I sold 145 of the Wisdom Tree hedged ETF, which netted me 11,126 in cash. And I also sold one share because I had 101 shares. And with trading options, especially if you want to do covered calls, you typically want to have 100 shares. So I went ahead and just sold one, the extra one, which I've got the dividends reinvesting for these or the distributions, and that's why I have one. So that netted me 268. So to start the week, I ended up having 12,511 in cash, which is a fair amount of cash to actually do cash secured puts. I also, just to kind of share with people, you'll notice down below, I also mentioned the returns I have with actually doing these trades. This account up through 2015 was actually managed by a professional. So he actually, or they actually put in here this Wisdom Tree hedged equity as well as the IGH. I later added DVY. I used them up until 2015. I think I started using them at like 2008, and I was paying 1%. But for now, I decided to keep 100 shares, and you'll see down below that I did sell a covered call. I do already have a covered call that I did back in May for IGH, but that will either expire or I'll close it. It expires in November 19th, so I'll be able to write a covered call on it. So let's go ahead and go down. Oh yeah, the point I wanted to make is I've looking at the returns, and I went back and I looked. I went back the last 10 years, since 4 of those years was run by the brokerage, and then I've taken it over in 2015. So I looked at the returns. So you'll see with some of the returns below where I came up with those numbers, but it was from actually looking at the account and looking at the brokerage statements to figure out what the returns were. And I was averaging close to around 15% with its IGH. With this HEDG, which is the Wisdom Tree Hedged Fund, I was only averaging around 5% a year, not very good. And again, I've had it for over 10 years, so I missed some great opportunity for some good returns with it. So here's the actual trades that I did, and I only did 4 trades, and you'll notice I just started a couple days ago. So the first was ARKK. You'll notice from a lot of my other videos, I really like ARKK, and I own some of it. I would like to own more. So I did a vertical put credit spread on the 29th, which was, I guess, Wednesday, and it expires in 16 days, or it's actually 14 days from now. And I did it at a strike price of 102, and the farther out, which is the lower value, I bought the put at 92. So the difference between those, the 102 to the 92, is $10 times 100 is 1,000. So typically I would need $1,000 worth of margin minus any cash that I brought in. So, and here you can see it was currently priced at 111. I think it's gone up since then, and I got premium of 117 for selling the option at 102, and then I got premium of, or I had to pay premium of 41 for the option at 92. So looks like it's about $80. So it was $920 or so for margin that I needed for that. Now, if I didn't have what I mentioned in the opening of the video, if I did not have the margin and option level 2, it would have ignored the 92 put, and it would have required that I had 10,000 of margin or 10,000 of cash to cover that. So I could not make all 4 of these trades. I probably could have only made 1 or 2. But I'm pretty secure. I've done enough of these trades that I know that this is not too risky, and I would be okay with picking up ARKK at 102, but I could probably roll it even lower if the market takes it even lower. So the next one was a covered call, and this is the covered call that I did on the Wisdom Tree ETF, and I did it for 78. I think it's currently at 76. The delta, I forgot to mention the delta for the ARKK was 0.187, which is, excuse me, which is close to that I always try to get to. I took a little bit more risk with the covered call here because I'm willing to give it up. Since it's had pretty poor returns, 5% in my mind for a hedged ETF isn't that good. Yeah, and here the current price is 76, and I got $42 in premium for that. It also expires in only 14 days from today, or 16 days from when I placed the order. So just in that one day, I made just shy of 120. And then I did this is big lots. This is something else I've always been interested in. I actually own it in some of my other brokerages, and it dropped big time yesterday. It dropped, I think, over $4. So I got some good premium with it. I also did it as a vertical put credit spread, 40. So it's currently at that point was at 43.91. So I did 40 for the strike price expiring on 11/19/21, and if I could pick it up at 40, I'd be really happy. Just I think 2 weeks ago it was over 50, like 52, 53, and part of the reason it's dropped so much is because of this supply chain stuff that's been going on. It's impacted them, but I think long term they'll be able to figure that out, and you know I felt like I got really good value, and if I can pick it up at 40, then I'd be really happy. And I forgot to mention that each of these is just one contract, so I did not do two contracts. A lot of you guys who've been watching my videos, I'll do two contracts, and I may move to that once I get used to doing this in my retirement accounts. And then, yeah, so it was 120, and then I paid 40 for the 35, so it's only 500. So again, $80, the difference between these two, and then I had the difference between 35 and 40 is $5 times 100, so that's $500. So this one only required $420 in margin. It is for a little bit longer, being at 11/19/21. So, but not bad, $80 for one contract. In my brokerages, I a lot of times will do two contracts, so I could have made 160 if I had done two. And then the last one I did, LEG, Liggett and Platt, and it's another great company, good returns, good income. I think it's a dividend aristocrat, and it's something I always like to own. And I did it for just a cash secured put, mainly because of the pricing, and I had enough margin. I thought, well, I'll do this as a cash secured put. Also, I couldn't make very much money if I did the cash credit spread or the put credit spread. So I did do expiring 11/19, so it is more like 50 days. Really low delta, 0.1677, which in my mind it relates to like an 83% probability. You just subtract that from 100, and that's like the probability that the stock will go 240 or below. And again, I'm more than happy to own it at 40. It's currently at 45.21. So, and it pays a good dividend. I believe at 40 it may be like close to a 4% dividend. And I did pick up $57.35. So this is where it really gets interesting. So I just did 2 days of trading. Wednesday and Thursday, I made $255. And on an account that's 50,000, you'll notice up here that going into it, the account was 50,608 in my retirement account. So I made 255, which equates to a yearly return of almost 6%. So you can already see if I could do this on a month by month basis. My original goal was 5%. I've already been able to beat it with spending maybe an hour and getting close to $255. This is the account return. This is since I've taken it over. I think I bought a little bit more of IGH. I believe I rounded it up to have 100, and I also put DVY in there. So I did 9.5%, or been averaging 9.5% in this account over this time period, 2016 to 2020. And then the total return, if I was actually able to do this every month, if I combine these two, it's almost 15.5%. So when I say 6%, I'm meaning above and beyond what, how much IGH grows, how much DVY grows. If I end up owning big or big lots, then how much it grows. So that would be 15.5%. And I have a little calculation with the rule of 72 that I would double it in 4.6 years, which is also really good. Which would get me, I'm 55 now, and that would be pretty close to 60 years old where I could start withdrawing funds from this, meaning it would double and be close to 100,000. Now, I wanted to share this because, like I said, a lot of this not contract, but this account was run by a professional, and so the advisor return from 2011 to 2015, and I did the calculations, was only 4.8%, which is really low, and I was paying him 1%. So a lot of this is on me. I should have done more. I should have looked at it more because, I lost a lot of potential in this account. If I had been managing it myself, and it looks like I've almost gotten double the return that he was able to get. And of course, the market was different during that time. But 2011 through 15 was also some pretty good years. I might have already doubled this account. So you can see running these accounts yourself and actually doing it yourself, you can actually earn some really good returns. So if I can earn this 15.5, and I think I can even do better. I'm thinking I might be able to do 8, 9, maybe 10%. We'll see. I'm going to share more videos. Now, why is this called the wheel strategy? Primarily because I'm buying cash secured puts, or I'm looking to pick up these stocks. So initially I'm selling puts. The only difference with the wheel strategy for me is I'm also doing the put vertical credit spreads, but I'm going to be buying these at a little bit more risk, or selling these at a little bit more risk, like you see I did with big, and I also what I already have in the account, I'm selling covered calls. So I'm okay if with my cash secured puts that if I get assigned, then I'm going to start doing covered calls. What I already have in the account, I'm going to be doing covered calls on, and that's the whole idea with the wheel strategy. So you sell a put, and you either get assigned or you sell another put. At some point, you're going to get assigned. So as I get more used to this, I'm going to take more and more risk. At some point, I will get assigned. Then I'm going to start selling covered calls on those same securities, big and LEG, if I get assigned for those, and ARKK. And that's kind of the whole idea of this wheel strategy, that this is how you pick up stocks versus just going out and buying them out in the market. There is some risk, but the amount of cash that can be generated is pretty overwhelming. So this is just the beginning of the turn of the wheel. So the wheel, I'm hoping I almost call it my return performance wheel, because I'm going to try to pick up speed, see how much I can earn on this. And being a retirement account, I don't run the risk of being impacted with taxes. So I'm willing to play a little bit more in this, and take a little bit more chances with it. So I also have down here some of the other things that I'm looking at. So I had mentioned in previous videos some of these other ones. So I've got the list of stocks that I'm looking at that probably next month I'm going to continue to buy. I feel like the market's going to be downtrending for a while. Unfortunately, I think some of the policies that have gone into place, people, too much incentive not to work. I think the market's going to be trending down, but I've always found when there are corrections, it usually bounces back, and long term it always grows. So I'm going to actually share this spreadsheet in my Patreon page for any of my patrons. Right now, I don't have any patrons, but anyone who does join it will have access to these worksheets. I'm also gonna, um, you know, set up a weekly. I'm thinking I'm going to combine the two. Right now, there's two levels of becoming a patron. I think I'm going to combine those into one at the lower price. And then for people who want a little bit of hand holding and want to try this themselves, I can work with you. I can help you learn how to do it. Um, for me, it's been a life changer. Between this and what I'm doing in my brokerages, I've been able to retire sooner than I ever thought possible. So as always, thank you for joining me. I hope you enjoyed this video. If you don't mind, hit the like button and subscribe. I'm a young channel, don't have a whole lot of subscribers, and I want to get the word out. This is huge. I never thought I could do this in a retirement account. And for those of you who are in your 20s, 30s, 40s, or like me in your 50s, sooner you start this, the better returns you can get. But again, let me emphasize, safe option strategies are the way to go. Don't be taking big risks. Don't be trying to get rich quick. So have a great day, and I hope you enjoyed this. Talk to you soon. Bye.